Chapter 9 discusses the government and fiscal policy. You have 5 minutes to read summary, pages 39 to 40, and then, there will be a short quiz. One. When you get your paycheck, what is left over after the government takes out its various taxes? Your total income minus net taxes is called disposable income. This is what is left over after paying your taxes to the government and receiving any income transfers from the government. Two. How can the government pull the economy out of a recession? There are different policy tools at the government's disposal. One of them is called discretionary fiscal policy. This consists of changing government spending or taxes in order to influence the economy. 3. If the government increases spending in order to stimulate the economy, how much will the economy grow? Any given increase in government spending will cause real GDP to go up by more than the spending increase. This is known as the government spending multiplier. The value of the spending multiplier is given by 1/1 MPC. Four. There has been a lot of talk about cutting taxes lately. How will tax cuts affect the state of the economy? Along with changing government spending, changing taxes is a major tool of fiscal policy. Tax cuts will stimulate the economy and increase real GDP. A tax cut will have less of an effect on GDP than a spending increase of the same amount. That is because the tax multiplier is smaller than the government spending multiplier. The tax multiplier has a value of MPC/1 MPC. Six. What is the federal deficit? How does it differ from the national debt? The federal deficit is the amount by which government expenditures exceed receipts. The national debt is the accumulated debt from past deficits. In 1997, the last year in which there was a deficit, the annual federal deficit was $53.3 billion. In 2000, the national debt was approximately $5.7 trillion. 7. What was the federal budget situation in the past few years? In the past few years, the federal budget has actually been in a position of surplus. In 2000, the surplus was $251.8 billion, which has raised questions about what to do with the excess funds. Nothing arouses as much controversy as the role of government in the economy. Government can affect the macroeconomy in two ways. Fiscal policy is the manipulation of government spending and taxation. Monetary policy refers to the behavior of the Federal Reserve regarding the nation's money supply. Discretionary fiscal policy refers to deliberate changes in taxes or spending. The government cannot control certain aspects of the economy related to fiscal policy. For example, the government can control tax rates but not tax revenue. Tax revenue depends on household income and the size of corporate profits. Government spending depends on government decisions and the state of the economy. Net taxes are taxes paid by firms and households to the government minus transfer payments made to households by the government. Disposable, or after tax, income, YD, equals total income minus taxes. Adding net taxes, T, and government purchases, G, to the circular flow of income. When government enters the picture, the aggregate income identity gets cut into three pieces, Y equals C plus S plus T. And aggregate expenditure, AE, equals AE equals C plus I plus G. A government's budget deficit is the difference between what it spends, G, and what it collects in taxes, T, in a given period. The aggregate consumption function is now a function of disposable, or after-tax, income. Figure shows finding equilibrium output/income graphically. The leakage/injections approach. Taxes, T, are a leakage from the flow of income. Saving, S, is also a leakage. In equilibrium, aggregate output, income, Y, equals planned aggregate expenditure, AE, and leakages, S and T, must equal planned injections, ING. The government spending multiplier is the ratio of the change in the equilibrium level of output to a change in government spending. Chart shows the government spending multiplier. Figure shows the government spending multiplier graphically. A tax cut increases disposable income, and leads to added consumption spending. Income will increase by a multiple of the decrease in taxes. A tax cut has no direct impact on spending. The multiplier for a change in taxes is smaller than the multiplier for a change in government spending. The balanced budget multiplier is the ratio of change in the equilibrium level of output to a change in government spending, where the change in government spending is balanced by a change in taxes so as not to create any deficit. The federal budget is the budget of the federal government. The difference between the federal government's receipts and its expenditures is the federal surplus, plus, or deficit. Table shows federal government receipts and expenditures in 2000. This graph shows the federal government surplus, plus, or deficit, as a percentage of GDP, 1970 I 2003-2. The federal debt is the total amount owed by the federal government. The debt is the sum of all accumulated deficits minus surpluses over time. Some of the federal debt is held by the U.S. government itself and some by private individuals. The privately held federal debt is the private, non-government owned, portion of the federal debt. The graph shows the federal government debt as a percentage of GDP, 1970 I 2003 2. Automatic stabilizers are revenue and expenditure items in the federal budget that automatically change with the state of the economy in such a way as to stabilize GDP. Fiscal drag is the negative effect on the economy that occurs when average tax rates increase because taxpayers have moved into higher income brackets during an expansion. The full employment budget is what the federal budget would be if the economy were producing at a full employment level of output. The cyclical deficit is the deficit that occurs because of a downturn in the business cycle. The structural deficit is the deficit that remains at full employment.